Okay, I'm gonna go over the practice for chapter 9. I really love um, this practice stuff. You guys should really utilize them because I know there's no check your work, but as soon as you turn it in, you can get the results back and it shows you each one that you got wrong. It shows you exactly how to get the right answer. Um, so you can utilize that. You can also utilize this video. Okay, and the other thing I love about this is for the most part, the main information remains the same from one question to the next. So you can step through the whole process with the same information. All right. The Preble company manufactures one product. Its variable manufacturing overhead is applied to production based on direct labor hours, and its standard cost card per unit is as follows. So it gives me 4 pounds at $10 a pound for $40 a unit. Um, 2 hours of direct labors at $16 an hour for a per unit cost of 32. A variable overhead, 2 hours at $6 per hour for a unit cost of 12, and a total standard variable cost per unit of $84. So I just took all of that and put this in this chart down here. So these numbers, I just pulled all of them out so I can reference them. Okay. And then the planning budget for March was based on 3,000 units. Got that right there. And then my advertising. So the company also established the following cost formulas for its selling expenses. Advertising is a fixed cost of $270,000. Sales, salaries, and commissions is a fixed cost of $240,000 plus a variable per unit of $19. Shipping expenses is all variable at $10 per unit. The planning budget for March is based on 30,000 units. However, during March, the company actually produced and sold 34,500. So my actual units is 34, oh, whoops, is 34,500 units. I purchased 150 pounds of raw materials, so this is pounds, at a cost of $9.20 per pound. All of this material was used in production. Direct laborers worked 62,000 hours at a rate of $17 per hour. Total variable overhead cost was $390,000, $390,600. Total advertising, sales, salaries, and commissions, and shipping expenses were, so advertising was 280,000, sales and commissions, sales salaries and commissions was 490,000, and shipping was 185,000. I really hate it when they put things like that. That is really why I pull things out. Okay, so I have all of my information here. And for my purposes, you could do this all in one sheet, but just for clarity, I've put them on different sheets. And so I just copied this same chart on each page, and it's just all the information up here pulled out so that I can see it and use it. Okay, so my raw materials cost is going to be um, the actual units, because remember when you're doing a flexible budget, you use actual units and standard and then standards to come up with the, yeah, the stuff that goes into the flexible budget. So raw materials is going to be the actual units times the direct materials per unit. So 34,500 times or multiplied by 4. Okay, so this is my total pounds. Gotta label this right. Okay, my total pounds times, oh, whoops. Okay, I'm just trying to write this out so you can see what this is. Okay, so there's my total pounds and my standard cost per pound is $10. And so 138 pounds times $10 a pound gives me raw materials cost of 1,380,000, which is the cost that would go onto the flexible budget for March. Okay. Materials quantity variance. So we're going to take the actual quantity, which they told us in A was 150,000. And this, so that's AQ times SP. No, it's not. Okay. So I'm doing this, the AQ minus SQ times SP. So I'm doing it the shortened version. So I'm still dealing with pounds right here. So the standard quantity of pounds is going to be the $4 per, or £4 per unit, sorry, holy cow, times the number of units. So I'm still dealing with pounds. And so the quantity variance in pounds is actual quantity minus standard quantity. And then my standard price per pound is $10, right? And so if I multiply the 12,000 times the $10, that gives me a materials quantity variance in dollars of 120,000. So my actual quantity was more than my standard, and so that is unfavorable. Because remember, the standard is what we thought was going to happen. Okay, question 3. Now they want to know the materials price variance. So again, this is going to be AQ times AP minus AQ times SP, or AP minus SP times AQ. So the actual price for direct materials was $9.20 a pound. My standard price is $10 per pound. And so if I subtract, that's 80 cents. My actual quantity, or pounds, right? My actual pounds was that. And so then my materials price variance is that 80 cents difference times the number of pounds. So it's 120,000 is my materials price variance, and my actual price was less than my standard, and so that is favorable. Okay. Materials quantity variance. Now that in question 4, they're giving us some extra information. But honestly, that's nice that we purchased that, but we're using quantity variance. So we're going to still look at the number of pounds used in production. And so I'm just going to use that 150,000, and the standard pounds, remember, is the pounds per unit times the units. And so we're going to take actual pounds minus standard pounds. Oh, yeah, that's right. Huh, that's funny. Materials quantity variance and materials price variance are the same. So equals the standard price and equals 12,000 times the 10. So normally that's not going to happen, but apparently it did. So equals 120,000. So it's the same number, but yeah, it's still unfavorable because actual was more than the standard. Okay, that's question 4. Question 5, materials price variance. Why do I feel like, oh, they're having this figure, anyway, whatever. Oh, now I see why. Okay, so this one for question 5, we will take into account the purchase, right? Because it's the price variance, how much we spent. So again, it's going to be at $9.20 actual price, the standard price, subtract equals this minus this. And then the actual quantity is going to be that 177,000 that we purchased, right? Because in the original, we purchased this and used it all. And now they're saying, well, what if we purchased this and only use this? So that's why, yeah, anyway. And so then our materials price range would be the 80 cents times the actual quantity of 177,000 for 141,600. But for some reason, this one's saying favorable. Remember why? Oh, because we're looking at something else. Anyway, that's not making sense in my head right now, but hopefully somebody else understands. Anyway, it is favorable though. Okay, question 6. What direct labor cost would be included on the company's flexible budget for March? So again, this is going to be based on the actual hours times the standard direct labor cost per hour. No, that's not right. Oh, okay. I see what I did. Okay. So I'm going to show you 2 different ways to get this. So I did, let's see. Okay, let's do the other one first. So equals the actual units times the actual cost per unit. Okay. Or if I wanted to make it longer and take more steps, no, that doesn't work. No, we're going to leave it at that because I don't want to confuse you. Yeah. Okay, so we're gonna leave it at that. Direct labor costs, just take, again, the cost per unit standard times the actual units made. And that will give you the right answer for direct labor cost. That's going to go on the flexible budget. Okay. Direct labor efficiency. Remember that's going to be AH times SR minus SH times SR or SR times AH minus SH. Either way. So the standard hours for the actual quantity is going to be the direct labor hours per unit times the units. So that's the actual units times the standard hours per unit. And then they told us that it was actually 62,000 hours. And so the standard hours minus the actual hours equals 70,000 hours. So right, this is hours. But when I'm talking variances, it needs to be converted to dollars. And so that needs to be times the standard rate, right? Because I was doing it this way, actual hours minus standard hours, or the other way around, whichever, times the standard rate. So the 7,000 times the standard rate per hour, which is the 16, gives me a direct labor efficiency variance of $112,000. And if I look at it though, my standard hours are more than my actual hours. So what actually happened was they were faster than I expected. And so that is favorable. Okay, question 8. Direct labor rate variance. So my actual labor cost they gave me, right? AH times AR, they told me was this. And my standard labor cost, AH times SR. So my actual hours times my standard rate per hour should have been that. And so then I subtract actual labor cost minus the standard labor cost allowed. And so that is variance is going to be equal to $62,000. And what actually happened was more than what I thought should happen. And so that is unfavorable because I spent more on labor than I had planned. So that is unfavorable. Okay, question 9. Variable manufacturing overhead cost would be included in the company's flexible budget for March. So again, that's going to be actual units. And I'm going to times that by the variable overhead cost per unit, that $12 right there. And so that is the variable manufacturing overhead cost that will appear on the flexible budget for March. So again, variable overhead, the $12 and the actual units. Okay, question 10. What is the variable overhead efficiency variance for March? So the actual hours times the standard rate, variable overhead efficiency. So based on actual direct hours times the standard per hour variable overhead rate. And then the standard hours, right? That's going to be 2 hours per unit times the units and then times the standard rate. And we subtract. Because we're doing the efficiency variance. And so that's 42,000, excuse me, 42,000. And my actual is less than my standard, right? Actual standard. And so that is favorable because I spent less on variable overhead than I had planned. Okay, question 11. Variable overhead rate variance. Actual hours times actual rate is just going to be that variable overhead total cost that they gave me. And then actual hours times standard rate again will be the hours per unit times the units times the standard rate. No, that's wrong. Oh, I see why it's wrong. Let's try that again. Delete that. Okay, so this one is going to be variable overhead is based on direct labor hours. So the actual direct labor hours times the standard variable overhead rate per hour. Okay, there we go. That helps me. Okay, so then I just subtract this minus this. And my actual, right, actual rate is more than my standard rate. And so it is going to be 18,600 unfavorable, right? Because actual AR was more than standard SR. Okay. Question 12. What amounts of advertising, sales, salaries, and commissions and shipping expenses would be included in the company's flexible budget for March? So this, we're going to use our cost formulas that they told us about, right? This chart right here. So I'm going to take for advertising, that is just a fixed cost. So that's just going to be the 270,000. Sales, salaries, and commissions has a fixed cost plus parentheses $19 per unit times the actual units, close parentheses. So there's my sales, salaries, and commissions. And again, shipping expense is just variable, so it's $10 per unit times the units. So again, advertising, it's just the fixed portion they told us. Sales, salaries, and commissions is going to be the fixed portion. Make sure you put parentheses plus parentheses, the variable portion times the units. And then shipping expenses is just variable, so it's the variable portion times the units. So that is what is going to go on the flexible budget. Okay, question 13. Spending variance related to advertising. So if you'll recall from before, my advertising is just that fixed portion of 270,000. And they told me I actually spent, right, and D, they gave me my actual numbers for advertising was this. And so it is going to be equals my, the standard for advertising was this, right? That they gave me in the chart minus my actual, and that is what I thought I should spend on advertising is less than what I actually spent. So I actually spent more than what I planned. And so that is unfavorable. Question 14, what is the spending variance related to sales, salaries, and commissions? So if you'll recall, on my budget, it was going to be that fixed portion plus parentheses 19 times 34,500, a total of 895,500. So that is what I thought was going to happen. What I thought was going to happen minus what actually happened. And so that's a 405,500 favorable, because what I thought was going to happen was less than what actually happened. So I actually spent less than I planned. That's why that's favorable. And then spending variance related to shipping expenses. If you'll recall, my shipping expenses was the $10 times the 34,500 units. And so what I thought was going to happen minus what actually happened equals 160,000. And that is favorable because what actually happened was less than what I thought should happen. So that's it. Hope that helps somebody.